Investor XP is off the week of June 12th through the 16th. And while we're off, we're still going to be uploading some videos that week. The most requested series that we've had is a video on investing for newbies. So this is the second video in that series. The first video in the series, if you haven't checked it out, go check it out. Important things there is getting your budget, setting up your account. Now, before we continue, before you make that first stock purchase, today we're going to look at another important aspect to learn before you get started, and that's the language, the lingo, the terminology that's used when looking at some of the basics of stock. You need to have these down so that you can understand what analysts are talking about, and they can give you some areas to look at in a stock to help you properly value them and give you an idea of if you're going to invest in them. Now, on all of these, none of them are the end-all be-all silver bullet that this is going to help you pick the right stock. All of them have to be taken in context, and basically it can be they can be used to point to good aspects and bad aspects of a stock. You have to get the overall picture of the stock. That's what we talked about in the first video. You have to get all your news sources, then you look at the statistics of the stock and what the analysts are saying. What we want to cover in this video is so that you understand what people are talking about and some basics of the stock. This will help you start picking them as we look at our next videos that are going to be out, which are going to be investment strategies. So let's pull up a statistics page. I like to use Yahoo Finance. Just because of the layout, it has everything in one place. I use it even though I use E-Trade when I'm just quickly thumbing through stocks. Yahoo Finance it's what I've always used. E-Trade in whatever trading platform that you use is going to have way more powerful tools and stuff, but these are some of the basics that I look at, and these are the most common statistics and measurements that people use, and this is the lingo that they're going to use when they talk about stock. So over on Yahoo Finance, click on the statistics tab of whatever stock you're looking at, and they have all these measurements. Now, the first one we're going to look at is market cap. Market cap is simply the size of the company. When you're looking at the market cap, it's the outstanding shares times the price that they're going for on the stock market, and that gives you an idea of the size of the company. It's broken up into different sizes when people talk about a mega cap, large cap, small cap, micro cap, depending on the company size. So if you look at their market cap, it tells you how large the company is, basically. Again, these have got to be kind of put in context if you're going to use them for anything. Generally, if you look at a smaller company, they haven't been around a whole long time, and there's more opportunity for growth. They can grow into a larger company. There's different angles you can take with it, but when you're looking at a stock price, a lot of people use the example of once upon a time it was IBM and Microsoft, whereas IBM was trading in the hundreds and Microsoft was in the 30s. Microsoft was still the larger company by when you look at the market cap size. So you can't just look at a stock and say, the price is $100, so that's the bigger, better company versus a stock that trades for $30. And that's not how the pricing works. But first thing, when people say it's a large cap, it's a small cap, market cap, that's what they're talking about, is the size of the company. Not a huge deal, honestly. Smaller caps, you can look at them as bigger potential to growth. Larger cap, more established companies that have been around for a while is kind of how I look at it. Not a big deal, but it's definitely a measurement, and it's terminology that people use a lot when you're talking to analysts and things. So the next one we want to look at is price to earnings. So you got your trailing and your forward price to earnings ratio. So what does the price to earnings mean? Well, the price to earnings is how many times it's the multiple for the company of how many times its earnings people are paying for the company. It's a measurement of how expensive a company is in a lot of ways. Now, again, there's a caveat to this. So a price to earnings multiple, the market average is around 20 to 25. That's the average valuation forward times earnings that people would pay up, the premium that they pay up for the stock. So if a company has a PE of less than 20, it could mean that it's a very cheap stock, and it's a good value investment. It's not as expensive as the average stock. This depends on what industry the stock is in. It could also mean that people aren't willing to pay a premium for the stock because its future growth prospects are there. So you can't make the blanket statement that 20 PE or less is cheap. It could mean that there's not a lot of good future prospects as well. A lot of people use it as a valuation method, but it can mean there's lots of future prospects if, for example, a Netflix is 100 times earnings. People or Amazon both have high PE ratios. It could just mean people are more willing to pay up that premium for the stock. It could also mean that it's extremely expensive and way overpriced. Example, Tesla trades at a very high multiple. That's one that I feel is not paying up for forward momentum. I think that's just a big hype trap. So you can look at it. You can look at it two ways. High PE, could mean way overpriced, danger, stay away, or it could mean this is a hot stock you need to get into, and people are willing to pay a premium for it. Same thing on the lower end. It could mean that it's a very cheap, it's a bargain buy at that price, or it can mean that people are staying away and it's a dying company. So, again, when you're talking about these terminologies, they're not the end-all, be-all, and they are good measurement tools that you can use, and it's what people talk about a lot. So you need to learn them so that you know exactly what people are referring to. PEG ratio is similar to PE. It actually uses PE to calculate it. So the PEG ratio is it's the price per share over the earnings per share, so it's your PE ratio compared to the annual growth. So you're looking at the growth potential in the future and what the PE is compared to that. So this is another one where it's tricky because it's not the end-all be-all to use. If they have some really good earnings potential there and the PE comes in, you may get a PE, let's say, that is lower than 0.8. This is considered by many as a strong buy stock. Anything below 1 is considered a buy. 1.2 to 2, that's where you're starting to get into the avoid area. And then if it's greater than 2, it's considered a high risk and that you should sell it because it's way too expensive versus what its future earnings are, the earnings growth. So PEG ratio not as widely talked about as PE. PE is used to gauge the PEG ratio. I will look at it once in a while. I generally just stick to PE versus what it is for its area of business that it operates in, whatever the stock is. But PEG ratio is also a very good one. Can be some tricky at times. Now we'll move on here. Those are the valuation ones that I look at. You can see I'm leaving out a good chunk of them. Price to sales, price to book, the enterprise value, anything EBITDA I stay away from, by the way. Those are all, they could all be good tools to measure. You don't hear people talking a lot about them, the price to sales, price to book, enterprise value stuff. They stick with the market cap and the PE or PEG. And those are good starting points, and you can get an idea of what they mean. All of these other tools, whatever platform you have, will tell you exactly what they mean, exactly what they could mean for the stock. They'll also have on the platform, I know E-Trade does, and I'm assuming all the other ones do, is where you can do a stock screener and you can put in certain PEG values or PE values, dividend payouts, etc., to find stocks that fall into where you like to buy them at. So that's another reason why you need to learn this terminology. But in this video, I'm just going over the very basics. So I want to look at next is the moving averages. When you're looking at your moving averages, your 50-day moving average and your 200-day moving average is just that. When you're looking at the moving averages, you got to think of it like a control chart, where these averages are filtering out the noise of your daily stock transactions, where you're up a little, you're down a little. Looking over the overall average, the overall pictures of where the stock has moved for the 200-day or the 50-day. So over those larger time frames, is your stock going above that average, below that average, or staying within those averages, can kind of predict where it's moving in the future. If it's breaking up above those, does it have some momentum behind it? Is it below those? Is it kind of cooling off a little, and is it, it stays there? And that's where they talk about resistance levels and things like that when people are showing charts. It's good to know, and it's good to look at what those averages are. I use it primarily to see, is there momentum behind the stock? Is it going above? Is it breaking out of those? If you see a stock that trades in between those numbers, and then, for a good period of time, then it starts to get close and it bumps up against it, breaks out, eventually stays out, that's a good indication that it'll break up higher. It gets some momentum behind it, and it stays up above those. People talk about that a lot. You need to kind of be aware of that. And when they talk about its new 52-week high, when 52-week high is over the last year, what was the highest price? People look for those indicators when a stock hits its 52-week high or a new all-time high. That's a good sign of momentum. They look for that range as, when it hits a 52-week high, makes a new record, and it's been trading up there. It's got, like Nintendo came out with the Switch. It hits new 52-week high. There's momentum behind it. Chances are it's going to keep hitting a new 52-week high every so often as it trades in a certain range. It raises its moving average, whether it's 50 or 200 day. So momentum is what we're talking about when we talk about those averages. Next, we're going to talk about the financial aspects of the stock, the income statement. Now, I generally don't talk a lot about the income statement, the revenue, things like that. It's not as detailed as it really needs to be to get down to the nitty-gritty of a stock. You need to know the basics of it to look at the financials of the company. I primarily, when I look at this, I look at how these things compare to what the CEO is saying about the stock, what their strategy is for the next quarter, for the year. Is there growth in the quarter? Is there growth in the year? Are their gross profits what they say they are? How close are they? I focus more on earnings per share, whether they hit that or not. The revenue, again, it's relative to what they say it was going to be, how predictable they are with that. Is it a hit or a miss? So an income statement, you got to compare it to something. Just looking at it and say, they did $220 billion in revenue. Okay, what were they supposed to do in revenue? What were they projecting to do in revenue? How much money did they make off of it? Was it as much growth as they thought it was? Was it less? Was it, what does it pertain to? So just looking at the financial statements, not a lot of info there. You really got to compare those items. So when I look at it, it's compared to their game plan that they have when you're looking at the investor relations compared to what their actual performance was, plan versus performance. So that's what I feel is more important than just saying, ooh-wee, they had 200 billion in revenue. Big number, it doesn't mean shit on its own, really. Another term that you'll hear a lot about is book value per share. This is a little tricky. Book value is in some ways the value of the company. It's the equity over the total outstanding shares. So book value per share is $25 for Apple, and you'll see a lot of times that it's much lower than the stock price. As it gets closer to the stock price, that can be a sign of a really good buy. If the stock price is below the book value, it could be it's one of two things. Could be a company in trouble. People are bailing out of it, moving away from it, or it could be a really, really good buy because you're essentially buying it at a discount. So you'll hear people talking about where it's trading relative to its book value. In general speaking terms, if you look at the book value, it's close to the true value of the company. Again, these are all not the end all be all. This is the true value of the company. No, it's the equity versus over the outstanding shares. So not the actual value of the company. If they were to liquidate, it would be closer to the book value per share. So it can be used to look at valuation of a company, if it's cheap or not, if it's worth buying. You'll hear people talk about that at times, and it's a good thing to know. So on to ones that are considered the end-all be-all by a lot of people, talking about the cash flow. Cash flow, a lot of people can use cash flow as hype for the stock. And a lot of people will say cash flow is king in what you need, but it's like everything else, it's not the end-all be-all. But so there's operating cash flow, and I'll pull up the statistics here in a second. That is the money generated. And you got to look at that. Is there enough money being generated by the business to fuel future growth opportunities? Okay, so that is your operating cash flow. So you want to see them compared to the size of the company they are. Are they generating enough cash to fuel for future things? And then you have your levered free cash flow, which is your cash flow minus your financial obligations. So this is the more important of the two, I believe. If you look at your free cash flow, this is the one you're probably going to hear talked about more. So this is the money that they got kicking around, again, after their financial obligations. And this is the money that can be used then for stock buybacks, paying out dividends, things like that. So if you see a company with a pretty high dividend yield, good payouts, steady payouts, and you see they got a ton of free cash flow, you should be feeling pretty good about that dividend. That starts going down, that starts drying up. Their cash flow starts operating, their cash flow starts not being there. I would start to worry about that dividend payout. So the cash flow, free cash flow, good things. You want to see a lot of it, and that's the money that they can use to grow their business ultimately. So one more statistic I want to look at here, and that is the dividend yield. Okay, so dividend yield, you can have your trailing or your forward, what they have. Dividend yield is, to me, one of the more important things, as I invest for dividend income when I invest. So the dividend yield is the annual dividend divided by the current stock price, and it's basically it's the bang for your buck, what you're getting for owning that stock. How much are you getting for that position? What kind of return are you getting? What are they paying you? What percentage to own it? So higher the better, obviously, and that's what you want to look for, is a good dividend yield. Certainly, you want something more than a savings account if you're buying the stock. You want your money, you want your investment to pay. You're taking the risk of owning a stake in the company, owning the equity. You want to be more rewarded than if you were just put it into an insured bank account. So you definitely want a dividend to be higher yield than what you would get from savings or a CD or something like that. Now, too high of a dividend yield is a red flag. Because it's usually not sustainable. So once you get to the point where it's too high, you can begin to worry, and that's where you have to look at cash flow and how the company is operating. There are some stocks out there that pay a very high, very strong dividend. The cell companies pay that. Different real estate trusts pay some high ones, utilities, things like that. Dividend yield is very important to me as a dividend investor, an income investor. May not be as important to you. Some companies, they don't pay that dividend, and the reason why they don't pay the dividend is because they could give you, the investor, $1, or they could invest that dollar into the company and grow the company even more. A lot of them say that's the route they want to take to continue growing the company. So yeah, usually it's a more mature company, a company that's been around a while. They're kind of set. They have their growth path set out. They still have some excess, and they return it to the shareholders who, through when they offered the shares of the company, they used that money to jumpstart, and it's kind of paying them back for their investment long term. So that's your basic statistics and lingo and language that you should know when you get ready to start investing. You'll see here there is a bunch of stuff I did not talk about. Like I said in this video, these are the basics to get you started. So when you're listening to someone on CNBC, you're reading an article about some analyst has got on Nintendo or Activision, this is the terminology they're going to use in those. They don't dive in too crazy on some of the other stuff. They usually keep it pretty simple. So this will get you started. This will help you research, listen to the news, get an idea. So until the next video comes out, what you need to do is familiarize yourself more with those terms. Start looking at those terms. Watch some CNBC, Fox. They have a financial channel, Fox Business. Look at some articles, Motley Fool, different things like that. See what people have to say relative to PE values, moving averages, things like that. Start to get a better idea, kind of immerse yourself in the lingo before you start making that first stock purchase. So if you watch the first video, you should have your account opened up. You should be ready to go. Now, after watching the second one, you know the lingo a little bit more. Start listening to the lingo, and the next video we're going to do is We're going to start looking at investment strategies so you can start making your first purchase. First investment strategy will be the next video. Second one is what I'm currently using with the kids, and the third one's kind of a real fun trading strategy. So look forward to those videos coming out. I hope this is beneficial for you, these newbie investing videos. I get asked about them all the time to put them together. I hope I'm doing it justice, and it's helping you. Let me know in your feedback, and there'll be another one releasing tomorrow. Thanks for watching.